Hello everybody and welcome to Managerial Economics discussion. This is chapter 1. In this session we are going to discuss about introduction or overview part of managerial economics. Under this topic we will specifically discuss what is the need of managerial economics, why we need to study, why we learn managerial economics, the reason behind why we learn managerial economics, definition of managerial economics, scope of managerial economics, and basic concepts of, or some basic concepts of managerial economics. Before proceeding to the main discussion, let us discuss about what is happening in the organization. In any organization, whatsoever the case, that means whether it is private, government or non-government like NGO, there is a conversion process of input to the output. Inputs can be called as factor of production such as labor, capital, land and entrepreneur. And the output may be categorized into two major divisions, that is goods and services. So whatever the company is, there is still a conversion process of those inputs to the outputs. For example, if we take academic institutes, there is a conversion of the input to the output, that is service. They provide service, educational service. And if we consider manufacturing companies, they convert those inputs into physical goods. In any way, there is a conversion process from input to the output. That conversion process will be managed by a manager. In the meanwhile, one of the main goals of a manager is to maximize the output. In the conversion process, a manager is aimed to maximize the profit of the organization. Maximizing the profit of the organization can be achieved by doing the following, or deciding or making proper decision on the following points. In order to maximize the organization profit, we need to decide, we need to make optimum decisions on the following points. The points are either to produce all inputs by ourselves or part of the inputs by ourselves, or purchase those inputs from the external parties or the external market, we can say. And the next is combination of inputs. The input combination and the method that we are going to use. The method of manufacturing, for example, mass production we can use, or job shop production, or batch production, or even the technology that we are using in the production. And the next is the amount of production, volume of production, and the price. We need to decide the optimum volume of production that can reduce overproduction and also avoid underproduction. It should be optimum. It should be optimum volume of production in order to avoid both overproduction and underproduction, because both over and underproduction results negative impact for the factory. If we consider overproduction, it may result in higher inventory cost, wastage of some products, and even our capital will be tied to that product, that goods. In the case of underproduction, it reduces sales. It is obvious. Our customers may not get sufficient amount of product from us, so they become dissatisfied and ultimately they will go to another competitors. So it is a negative impact for our organization. And the other is making single product or producing several different types of products. We need to decide. And the other is the reaction of our firms to the decision made by the competitors. For example, if our competitors increase their product's price, so what will be our discussion? What will be our decision? Our decision should be either increasing similarly or decreasing, or it may be other measures. In general, these are not the challenges faced by the manager while the manager is trying to maximize the profit. The manager may face much more challenges. Among those challenges, these are the main challenges that the manager needs to make proper decision. In order to make proper decision, here is the main point, by the way. In order to make proper or optimum or near to correct decision, a manager needs to use tools, concepts, and theories of managerial economics. Here is a point. A manager needs to use tools, concepts, principles, theories of theories of economics in order to make proper or optimum decision making on the above listed issues. Next, let us see now the definitions of managerial economics. Managerial economics deals with the application of economic concepts, theories, tools, and methods to solve practical problems in a business. There are problems in a business, so we adopt those concepts, theories, tools, and methods to solve that specific problem. This is what we call managerial economics. Sometimes we call applied economics in a business. As you know, managerial economics is a combination of two terms, that is management and economics. Let us see each term one by one. Management is a process. It is a continuous process, by the way. It is a continuous, never-ending process. Process of 5 functions. We start from planning, then organizing, then staffing, then directing, and the final step is controlling. Controlling what we have planned before. Or we can say management is doing through others, or both art and science. We can define management as both art and science. And a manager is a noun, as you know. A manager is a person who directs resource to achieve a stated goal, or a manager manages the conversion process of input to the output in order to achieve the stated goals. Management is a process and manager is a person. It's a noun and it's a person. On the other side, economics is a science, or we can say it is a social science, categorized under social science, which is organizing and allocating of scarce resources to achieve the desired objectives. Or it is a study how the society uses limited resources to achieve their unlimited needs. By the way, here there is limited needs, limited resources, limited resources, limited inputs, and on the other hand, we have unlimited needs. It is a social science that deals with the behavior of human beings in the production, distribution, consumption of goods and services in a world of scarce resources. Now let me take a pause and let me ask you one question, that is, what will be economics if resources are sufficiently available, or if we have unlimited resources. Okay, if we have unlimited resources in general, there is no need to study economics. Economics can't exist if there is unlimited resources. If there is unlimited resource, there is no economic, no need to study economics. Moving forward, economics can be majorly categorized into macroeconomics, microeconomics, and macroeconomics. Microeconomics, as the name indicates, it is a study of individual economic behavior. For example, the study of someone's demand or an individual's demand, or the study about the supply of one company or a firm or the demand of that company can be termed as microeconomics. It is a study of individual consumers and producers in a specific market. For example, supply and demand, price of output, costs, and incomes can be categorized into microeconomics. When those individuals will be aggregated, will be summed up, and they can form the aggregate level of economy, that is macroeconomics. Macroeconomics study about the aggregate economic behavior of the market. The aggregate economic behavior study about the aggregate economic. The aggregate can be obtained from the individual economic behavior. For example, national output can be aggregated. Those individuals living in some specific nation is aggregated, and when we aggregate the Ethiopians, for example, we can get the national level variables like national GDP, unemployment, inflation, physical and monetary policy, trade and finance among nations can be termed as macroeconomics. Macroeconomics. In general, managerial economics majorly based on microeconomics theories and concepts. Let us see some more details about microeconomics and macroeconomics. By the way, sometimes we can say macroeconomics and microeconomics are the scope of managerial economics. As you see, microeconomics have different theories of demand, can be categorized into different theories of demand, or microeconomics includes theory of demand, theory of production, pricing theories, pricing profit analysis, and theory of capital and investment about a single firm or a single individual. These theories are concerned about the individuals, whereas the economic environment, the social environment, the political environments are the aggregate level of economic behavior. And majorly, as we said in the previous slide, managerial economics is concerned about or uses those theories of microeconomics majorly. Proceeding to the next section, as we said before, for the economics to exist, there should be a scarce resource. Scarce resource on the one hand and unlimited wants on the other hand. Unlimited wants on the other hand. So economic problem arises because of the scarce resource in one hand, the scarce resource in one hand, and unlimited wants, which is very more, or which is greater than that of the scarce resource. By the way, our needs are unlimited. If we fulfill one need, we also extend our needs to the other needs. So our needs are unlimited, but our resources are limited. So the economic problem arises because of these two issues: scarce resource on the one hand and unlimited. Let us generalize the definitions of managerial economics. Managerial economics uses economic concepts and moving to the next section of managerial problems. By the way, there is managerial problems because of the scarce resource. Managerial decision problems. Among managerial decision problems, one is product selection, selecting what we are going to produce, the output, volume of output, pricing, what price should be stated for making the profit and to be competitive in the market. Internet strategy, organization design, the design of the organization, the layout of the organization, product development, promotion strategy, worker hiring and training, investment and financing. These all are the management decision problems that needs good decision by the manager. And there are economic concepts, margin analysis, theories of the firm, industrial, public choice theory. These are the concepts from economics. And on the other side, there is quantitative methods like numerical analysis, statistical estimation, forecasting procedure, and so on. So, the manager uses both these economic concepts and quantitative methods to solve the management decision problems in order to get on the optimal decision, in order to arrive the optimal solution to the above management decision problems. The manager uses economic concepts and quantitative method to get the problems, to get the answer for the problems, to get optimal solution for the problems. This is all about the definitions of managerial economics. There are some common terms in economics like scarcity, unlimited resources, and wants. These are important terms frequently used in economics. This one is let's move to the next section, and these are some basic concepts about managerial economics. As you know, because of the scarce resources, because of the resources are already scarce or limited, by the way, whatever the country is or whatever the individual is, if we take the wealthiest individual or the wealthiest country in the world, still there is a gap between needs and resources. In general, there is scarce resources, or resources are scarce, and that scarce resources make us to choose or make us to prioritize our problems or our needs. We need to prioritize our needs according to our maybe criteria of prioritizing the list. So there is a need to choose between different use of scarce resource, maybe different use of combinations. Economic choice is a must because of scarce resources. Economic choice is deciding between different use of scarce resource. Here is the main point. That is opportunity cost. It is the amount of other products that must be forgone or sacrificed to produce a unit of a product. For example, if I have 100 birr and if I have two needs, that is buying item A or buying item B with my 100 birr, I have two choices, either buying item A or buying item B. But 100 birr is not sufficient to buy both, so I need to choose one. If I want to choose one, B will be the opportunity cost, that is the foregone or the sacrificed. If I choose A, B is the second best alternative foregone. The second best alternative foregone. That is the opportunity cost. The opportunity cost of using or selecting product A, buying product A. B can be the benefit that is lost in making a choice between two competing use of scarce resources. So when I choose A, I miss B because of choosing A. So B is an opportunity cost, the missed cost or the sacrifice or the foregone. Let us see some more examples about the opportunity cost in the next slide. These are the decision maker, by the way. In the first column, there are decision maker, the business, the government, the individuals. They have to choose either of the two products. For example, for the business, new computer or fax, new worker or delivery man, office party or pay for both. And the government is also two alternatives: unemployment benefit, new roads, weapons, more hospital beds. Individuals can also make a choice between Mars bar, using Mars bar, or to get service in 2x bar, either to buy a t-shirt or to buy DVD, to go beach holiday or fixing the roof. These are the alternatives, and the business chooses this column. The business, the government, and the individuals chooses this column. Thus, these are the missed one. They didn't choose this. So these are the opportunity cost. What they could have done. These are the opportunity cost, because the business selects, the government selects, and the individual selects this column. Because they choose this column, the last column is an opportunity cost. In general, everything has an opportunity cost. And this is all about today's discussion. If you have comment, suggestion, or question, you can put it by the comments. You can put it either in Telegram or on YouTube channels. So I will respond to you later. And if you want to read more, use this reference books. So thank you for listening. Have a good time. Bye.